The economic data is pointing to a soft landing in the United States economy, and the Federal Reserve has started to cut interest rates. Investment markets are backing the no recession view. We're watching weekly jobless claims as a guide to whether the soft landing is playing out. Hi, I'm Andrew Pease and I'm the Chief Investment Strategist for Russell Investments. Welcome to the fourth quarter update of our 2024 Global Market Outlook. The 1990s seem to be back in fashion with the announcement of a reunion tour by Britpop band Oasis. Investors are hoping for more 1990s nostalgia in the shape of an economic soft landing, as the mid-1990s was the last time the US economy avoided recession after aggressive Fed tightening. The stakes are high. Markets are priced for a soft landing, so even a mild recession could trigger a significant equity market correction. For now, a soft landing looks the more likely outcome. Importantly, the Fed has begun to cut interest rates before clear signs of economic stress have emerged. If we had to choose one indicator to watch over the next few months, it would be weekly initial jobless claims. These will provide the clearest real-time guidance on whether the economy is rebalancing or drifting towards recession. Initial jobless claims sustained above 260,000 per week would be a red flag that a more painful adjustment is underway. Conversely, jobless claims that remain below this level would be a sign that tight Fed policy hasn't crashed the economy. Economic prospects are brightening in Europe and the United Kingdom after both regions experienced near recession conditions during 2023. The different growth trajectories over the past couple of years means that these economies are out of sync with the United States. This makes it likely that Europe and the UK can continue to recover if the United States experiences a soft landing. A recession in the United States, however, would flow through to the rest of the world given the impacts on global trade and confidence. Japan's economic performance is patchy, and the Bank of Japan seems determined to raise interest rates further. This, combined with the strengthening yen, is creating economic headwinds. The China outlook has taken a turn for the worse as the property market problems remain unresolved, credit growth slows, and consumer confidence hovers near record lows. Large-scale stimulus measures haven't arrived, and until the government decides to act, it's difficult to see a meaningful rebound in economic growth. Let's turn to our asset class outlook. We assess the market through our cycle, valuation, and sentiment framework. The improving prospects for a soft landing means the cycle is slightly more positive. Valuations for risky assets such as equity and corporate credit are expensive. Government bonds are fairly valued across most developed markets. Our investor sentiment indicator shows that market psychology is only moderately optimistic and not close to an extreme of euphoria that would warrant a more cautious stance in our portfolio strategies. We're not currently seeing strong tactical opportunities across equity regions, sectors, or styles. The value factor, small caps, and emerging markets offer good value. Government bonds offer good portfolio diversification benefits in case there is a hard landing for the US economy. The high-yield investment-grade credit markets, however, are unappealing given the low default rates that are currently priced in. Listed real estate and infrastructure are attractively priced and should benefit from central bank rate cuts. For currency markets, the US dollar is expensive and should decline as the Fed cuts interest rates by more than other central banks. This provides some upside potential for sterling and the euro. The yen is still relatively cheap, although its strong rally in recent weeks has reduced the upside potential. Within private markets, the rate cutting cycle should help commercial real estate finally find a floor. We like the yields offered by private credit, although picking the right manager is critical. Former Fed Chairman Alan Greenspan was dubbed the maestro for his skillful handling of monetary policy during the 1990s. Investors are hoping that Fed Chair Jay Powell's timing of interest rate moves is just as adept or lucky. Markets are priced for the soft landing, which creates an asymmetry in the return outlook with a potentially significant drawdown if a recession eventuates. The economic data says soft landing, but as Oasis declared in the title of their 1994 debut album, it's a case of definitely maybe. Thanks for watching. Please take a look at the full market outlook report and we'll talk to you again soon.